Welcome to this special segment of Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm pleased to have with me today Dr. Robert McHugh. I'm conducting an interview with Dr. McHugh because I believe we are very near a momentous period in American history and the history of markets that have been caused by decades of monetary and political abuse of what was once a prosperous free market capitalist economy in America. Let me try to explain where I'm coming from and why I think it is so important you hear what Dr. McHugh has to tell you today. In 1967, I had a college professor named Dr. Peyton Yoder. He was at a small Mennonite college at Heston, Kansas, called Heston College. Dr. Yoder was convinced that there was a correlation between the debasing of a currency and the demise of a nation's work ethic and its morality. Well, now, I'm quite a bit older. I'm 67 now. As such, I recall the presidency of Dwight David Eisenhower, who warned of the military-industrial complex. President Eisenhower, by the way, was the last president to have the gold supply in America audited. I recall the presidency of John Kennedy, who warned of the dangers to our liberty of secret societies that gain control of our government. And I remember very vividly the speech that Richard Nixon made on Sunday, August 14, 1971, when he removed gold from the backing of the U.S. dollar in what he said 43 years ago would be only a temporary policy. What followed that fateful August 15, 1971 enactment of gold's detachment from the dollar was the start of a cancerous monetary creation and the big lies that it fostered. The biggest lie of all was that we can have greater living standards not by working harder and saving more, but by working less hard and spending more and taking on more debt. In my view, believing that big lie our governments tells us that you can have something for nothing not only led us astray financially, but morally, spiritually, and socially. The relationships that began to deteriorate as a result, I believe, of that false assumption. And with that came the demise of the very basic building blocks of a healthy society, namely the family. With the breakdown of the family has come a decline in the educational standards, for example, such that the U.S. now lags most of all the advanced nations in terms of its educational success. Never do the politicians call for a re-examination of the real causes of these problems, namely a breakdown in the moral fiber of the American people caused by an immoral monetary system. Nor do the Federal Reserve officials ever seriously look at the real cause of our economic malaise, namely a fraudulent currency that is created out of nothing and then used to foster that big lie that we can have something for nothing, not to mention used to reallocate wealth from those who create it to those who control it, namely the politicians and the bankers. Our fraudulent monetary system has been in place so long now that most people don't have the foggiest idea that the premise of our policies are wrong to begin with, and as such, we have allowed stress to build up in our financial and political system to the point where a massive breakdown of our political and economic system is now imminent. But ignorance is no bliss, any more than if you were driving over a bridge that was about to fall down due to the stresses and cracks in that bridge that occurred over years of abuse and misuse. To help us visualize the stress fractures of our markets and economy, I have invited Dr. McHugh to pass along his insights and warnings to you. In my view, the enabler of most of the problems we have now in our markets and in our political system was the debasement of our monetary system, starting with Franklin Delano Roosevelt in the 1930s when he detached gold from the monetary system in the United States, and then after that with President Nixon's demolition of the gold standard internationally in August 15, 1971. But there is something even more basic, in my view, that underlies the reason we went off the gold standard in the first place, which I will address in a segment following my discussion with Dr. McHugh. So let me introduce to you Dr. Robert McHugh, who has been with us several times in the past on Turning Hard Times into Good Times. Dr. McHugh is President and CEO of Mainline Investors, Inc., founded in 2003 to provide technical market forecasts for stock and precious metals markets, offering trading education and a platinum trading service for subscribers interested in managing a speculative segment of their total portfolio to achieve above average returns. And you can go to, and I would really suggest that all of you take this website down. It's Technical Indicator Index, technicalindicatorindex.com. It's where you should go to catch up with Dr. McHugh. He is the author of a book called The Coming Economic Ice Age, which I have in my hands now. I've read through it. It's a compelling read if you really try to understand what is going on in the markets, why things have become so volatile. I think you'll find an awful lot of those answers right there in The Coming Economic Ice Age. So welcome, Dr. McHugh. It's really good to have you with me again.
Thanks, Jay. It's always a pleasure.
Always a pleasure to talk to you as well. Before we get started with our discussion, I would like to, my listeners again, I would just like them to jot down technicalindicatorindex.com, technicalindicatorindex.com. I am a subscriber to a service, part of what Dr. McHugh offers. It's almost a daily service. Almost every day, I think you write something, don't you, Robert?
Pretty much every day, yes. Once on the weekend and every day during the week. Yeah.
And the weekend really is a very comprehensive review of where things stand, but lots of timely information. And I got to tell you, after a day like today, and we're recording this on the 15th, Wednesday the 15th of October, it was quite a day with the Dow down some 400 points at one point. And it's just a very uneasy feeling that you have as you watch this market unless you're prepared for it. In your book, Dr. McHugh, you talked about what was published last year, actually. I think about this time last year, was it, in 2013?
That's right. We put it out about this time last year, and we said watch out for late 2014 and into 2015.
Well, it's quite prescient, it seems. You talked about the megaphone formation in the Dow and other major indexes in your book, and that these are very bearish formations for the stock market. And you've chosen to name those formations, though. You've chosen a name of your own. You call it the jaws of death. Can you describe for our listeners what the megaphone formation is and why you have chosen to rename it the jaws of death?
Sure, Jay. This is a pattern that appears at tops of all the major bull runs over the last century. It is a formation where you draw a trend line along the top, connecting the highs of the previous several periods, and then draw a trend line connecting the bottoms of several prior declines. And the symmetry is identical up and down. It's like a perfect opposite mirror slope up and down, and they widen as you go further into time. So it looks like a shark with its jaws wide open. Mm-hmm. And the reason I call it the jaws of death is because inevitably at the end of these patterns, the stock market has a violent decline, and we usually end up with a severe recession, and quite often we end up almost every time with a world war.
Wow. Well, you've given several examples in your book of megaphone or jaws of death formations, and they didn't all end in world wars. A number of them were, I'm just trying to think what some of the other dates were. For example, 1929, I guess that's an example of one that did end in a world war about that time. But we've had wars. We've had ongoing wars, it seems, in the United States. But it seems to be there were some other smaller ones that didn't really end in world wars, but were nonetheless a lot, increased activities in wars. For example, I've jotted some of these dates down. If I understood what you said in your book, 1929, 1957, 1965, and then you touched 1972, 73, 86, and 87, 1998, 1999, and 2007. Were those all periods of time when this jaws of death or megaphone formation, at least, was evident in the equity markets?
Yes, that's exactly right. And almost every one of those had some type of a world conflict. Vietnam, Korean, the Iraqi wars,
right.
1 and 2. So there is a definite one-to-one correlation with wars. They may not be called World War I or World War II, but they have involved a lot of nations and created a lot of turmoil throughout the world. As each time these patterns show up, it's amazing when these things come, because they reflect the psychology of mankind at a particular point in time. That's why they're accurate. That's why they work. They're measuring mankind's psychology. It turns very negative, very conflict-oriented, very unsafe, unstable, very messed up, just in an easy way to say it.
Sure. Well, if I look at the at your chart that you show on page 32 of your book, the coming economic ice age, I look at the Dow chart of the Dow, and you see violent decline in 2000, from 2000 to 2002. Then, of course, the famous one in 2008, 2009. And then, of course, we have new highs. We've had new highs during that period of time. So it seems to me that you have increased volatility over a longer period of time. And I guess this is suggesting instability in the markets, right?
Yes. And I think the thing that's most fearsome about the current jaws of death pattern is this is a massive pattern that's been going on for 25 years, and it contains two other jaws of death patterns that were smaller inside of it as component patterns while this was going on.
Uh-huh.
This is the largest pattern I've ever seen. It's larger than anything we've seen in the last 125 years. I took it back to 1900, and it's just the largest we've ever seen. And the size of it implies a decline economically on a scale larger than anything we've seen, and I fear a war larger than we've seen. It's the psychological measurement here is such that there's danger coming at us from all directions. The mindset of mankind now is very negative, very bearish, and bad things are coming and will be a consequence starting, I think, probably right now they're starting.
We see, of course, increased turmoil and problems of all kinds, Ebola breaking out, ISIS, increased wars, a new conflict with Russia, it seems, again, increased hostility with China to a certain extent, I would say, Chinese instabilities in their economy and a decline in the growth of that economy. Japan's in bad shape. Europe is having lots of trouble. So it does seem like there's increasing tensions and problems around the world. One of the things you talked about I find very interesting, and you talk about it frequently and keep your subscribers up to date, is something called the Hindenburg omen. Can you tell our listeners what the Hindenburg omen is, and why is that so ominous?
Oh, sure, Jay. The Hindenburg omen is an independent measure of the underlying health of the stock market at any particular point in time. It has appeared before every single stock market crash over the past 125 years. Over the past 35 years.
Mm-hmm.
I went back to 1987 with it. It is a condition in the market that where the number of new highs and the number of new lows are both simultaneously above a threshold at the same time that the majority of stocks are declining, at the same time the 10-week moving average is rising. And what this is it's an uncertainty in the market that is so clear and so dramatic that it can only lead to trouble.
Mm-hmm.
Or let's put it this way, it has a high risk of leading to trouble. Right. Not every Hindenburg omen results in a crash. About 1 out of every 4 does. But the ones that did not result in a crash, 70% of the time you're going to get a decline of something like we're seeing right now, 5 to 10%. Mm-hmm. So it does signal that for a healthy market, you have to have everybody on board that it's going up or everybody on board that it's going down. But when there's a dramatic fight going on of whether it's going up or down in a trend, that's when you have a very unhealthy market because you lack clarity. Mm-hmm. And lacking clarity is one of the most negative aspects, characteristics of a stock market for it to continue higher. It really simply can't.
So you might say that it becomes a very emotional market, one in which people are gripped with fear on the one hand, and others are optimistic and hopeful. You have a divergence essentially of the attitudes and emotions of investors.
Yes,
mm-hmm.
And that has appeared before all the crashes, or I call it crash 15%. So there have been several 15% declines since 1987 that people probably don't remember, that the media didn't talk that much about.
Sure.
But this omen appeared before every single one of them, except one. In August of 1911, we had a a 1 week 17% decline. The HO was not there at that point.
Mm-hmm.
But of the other, what I call crashes, it showed up every time. And we got one in September 19th of this year. We had another official Hindenburg omen. And the very next day, the stock market started declining in what now is it's about a 9% decline so far.
Okay.
From September 19th.
So we have a little ways to go before you would officially label it as a crash. I believe, correct me if you're wrong, but you see the highs of for this equity market, at least for the Dow, of September 19th?
I do. At this point, I believe that may be the top for the market for a long, long time. And the reason I say that is because the jaws of death pattern looks like it completed at that date, and where the price of the stock market reached the top boundary line. And then we had a rising bearish wedge, what I call a wedge, which is a subs pattern underneath the jaws of death, which is a termination top pattern, and that completed at the exact same time around September 19th. And stocks have since dropped dramatically below the bottom boundary of that pattern, which is a very bearish development. Stocks have fallen below their 200-day moving average now, which is a very bearish development. And so we have a clear signal from technical analysis that this market has a long way to go in just the first leg of what I believe will be a massive bear market.
Mm-hmm.
I think we could see the industrials down to 14,750 over the next 6 months, and then maybe we'll see a counter trend rally. But eventually, I see the Dow dropping all the way down below 5,000, and the S&P 500 dropping well below 500.
Wow!
By the time this whole thing is done, many years from now.
Okay, so this is a multi-year thing. I guess, though, you're not certain whether it's going to be, I remember reading something just recently, a short-term or a relatively quick decline to those levels would be several years, though, I believe, in your view.
I think it's going to take time because I think the Federal Reserve and the market makers, Wall Street, will fight tooth and nail to prop this market up and keep it as high as possible. See, many years ago, the government, it was illegal for them to buy stocks. Well, apparently that doesn't matter anymore, and the Fed, through the plunge protection team, just comes in and buys futures and stocks through their surrogates, Wall Street. And, of course, we know that they just sent $5 trillion of cash to Wall Street in order to do many things, including prop up the stock market. But the problem is they can only buy so much, and the market is so heavy, and bids are so scarce, and the world confidence is dropping so fast, and so much strife is occurring in all phases of life right now and all around the world that are really irreversible in many cases, that I don't see a clear way out of this for many, many years. I think we've got a runaway freight train that's just getting started now.
Yeah. Well, 1987, I believe, is when the plunge protection team started doing that. When during the Reagan years, during the '87 crash or thereafter, is when I believe, Robert, it's my understanding, that's when the government started buying and started manipulating the markets like that. 1987. So we have, of course, this huge amount of debt too. I mean, even if for those of us of a more fundamental orientation, we look at the debt that is growing exponentially, cannot be repaid, that it just seems to me that there's at some point along the way, there's all engineers know that systems have their limits, and it would seem to me that there is some limit. Clearly there's some limit. It seems to me what you are signaling to your subscribers is that we're getting very close to that breaking point. I
believe we are. I do. 100 trillion of unfunded liabilities, that's a trillion with a T. I mean, it's insane. And here's the thing, that people may not be aware of what the Fed is doing, but the Fed is tightening the money supply right now at the very worst time possible. The way they've been saying it in the media is that they've stopped QE2 or QE3, that they're no longer buying $10 billion of bonds every month. Mm-hmm. The truth of the matter is they're actually pulling money out of the economy right now aggressively by doing nothing Because the Fed holds $5 trillion of bonds and securities that they've acquired over the past 5-10 years, they are owed money from corporations, municipalities, and federal government in the economy. If you put a wall up and separate the economy versus the Fed, if it's in the Fed, it's not part of the economy. If it's outside the Fed, it is part of the economy. Mm-hmm. Just by having bonds that are maturing, just by being owed coupon payments on those bonds, money must flow from the economy, government agencies and the corporations and the municipalities and the mortgage-backed securities, the issuers of these bonds. They have to send money to the Fed, just as a matter of these instruments rolling off the Fed balance sheet through maturities or coupon payments due because interest is due on these instruments. That's all. That's an enormous amount of cash flowing from the economy to the Fed, and that is pulling money out of the economy. That is a tightening of our monetary supply at the very worst possible time. It's a gigantic mistake. It's a consequence of the QE3 programs. They had 3 of them. And as a consequence, they kicked the can down the road with these QE programs. Well, now it's time to pay the piper. Mm-hmm. What are you going to do with all these bonds if you're the Federal Reserve? The only thing you could possibly do is forgive the debt so that the cash doesn't come from the issuers over to the Fed in order to stop the money supply from leaving the economy and heading to the Fed. They're not going to do that yet. They may do that down the road. They're not going to do that yet. So we have this enormous monetary tightening going on that nobody's talking about.
Yeah. In fact, we've had Richard Duncan, a former economist of the at the IMF, on this show, and he's insisting that the Fed will, in fact, not be able to continue tightening. And I wasn't aware, actually, Robert, that the Fed was sort of through the back door tightening as they are. You know, there's all kinds of talk about they're going to phase out quantitative easing. Tapering is the terminology they use. But I wasn't aware that it was that restrictive already. So that really could account for some of the reasons that we're starting to see this pullback in the equity market, I suppose.
I do believe that.
Yeah. In addition, you know, you are best known, I think, probably for your Elliott wave analysis. And I might just mention also that another of your fellow Elliott wave practitioners, Robert Prechter, also has labeled September 19th as the high for a long time to come. And Prechter is actually looking at something, unless he's come up with something different recently, at a sub 1,000 on the Dow. So you're quite bullish compared to him. But I don't know that a sub 5,000 will look very bullish to very many people, and an awful lot of pain that is to come as a result of that. So you use, you have this jaws of death, which to me in some ways is really sort of goes along with the Hindenburg omen and some of these other technical tools that you use, Elliott wave, of course. But I'm told that we have to take a break now. But when we come back, Robert, I'd like to ask you about your plunge protection team indicator and some of the other tools that you use that are telling you that we are, at this time, most likely heading into a massive stock market and economic decline. So please, folks, I hope that you'll stick with me. On the other side of the break, we'll be right back with Dr. Robert McHugh with much, much more.